Hello and welcome to another episode of Darwin Investors. All right, so we had a nice day in the market today, but like a lot of people, I'm way down this year, at least so far this year, in unrealized losses. I think something along the lines of like 20% down. And these are some really good stocks, like really nice securities. And so I started thinking this weekend, like, why did this happen? How did this happen? Who's to blame? And how can I prevent this from happening again? What lesson could I take from this? So there was a shutdown in China. There's, multiple episodes of the pandemic. There's a war in Ukraine. We got a stimulus that was of like what, $2.2 trillion of stimulus pumped in the economy early in 2020, another 900 billion late in 2020, another 1.9 trillion in 2021. We had the Fed buying back $120 billion worth of mortgage-backed securities and U.S. Treasuries every single month. So who's to blame for my being down all of this money this year? Well, after thinking about it, was it Trump? Was it Biden? Was it Jerome Powell? Was it some like diabolical short selling hedge fund? And after thinking about it, I was like, no, it's me. So let me go ahead and share my screen. I'll show you what I'm talking about. So I'm to blame because this is not really a true bear market. What we have going on this year is a really well telegraphed market correction, and we should have seen that the valuations were too high, but whether we chose to admit it or not would be on us. But at the end of the day, what we've got is a market that if you got in like I did, I started managing my own account like in March of 2020. And where I had been up about 87%, I'm still up 33%. And I've actually been able to learn a really good lesson. And if you think about it, if you were like a Robinhood trader, and people give them a lot of grief. Let's say you start off with $2,000. Let's say you bought NFTs and you bought Bitcoin and AMC and GameStop and every SPAC under the sun, and you went from like $2,000 up to like $50,000, and then all of a sudden it came crashing back down, and now you're down to like, I don't know, $400. And you may say that you lost $49,000, but you didn't really. What you did was you got a fantastic market education, like the same as I did, and you got it for $1,600. Where are you gonna get a market that's gonna send you to the moon and then back down to the floor and then teach you about valuations and how to trade options and all these things, and do it for $1,600? And that's what happened to a lot of people. This has just been it's been the greatest market, and it's a great one to learn off of, and you can still come out a little bit ahead. At least I'm ahead. And so what were the clues that this was an overpriced market? And I'll show you how I knew it was already overvalued and when I knew it. I'll tell you exactly when it turned for me. And actually, that for me would have been February of 2021. And then we're going to talk about the Fed. And today they talked about, they're going to get their soft landing. But remember, they're going to get their soft landing by their definition. And their definition and our definition is two different definitions. And I'm going to tell you what that means, what I believe it means for the job market, for the economy, for profit margins and things of that nature, and what that means for our accounts. And do I think there's going to be a recession? Well, I think that we might well already be in a recession, but it's going to be a really strange recession, and it isn't really going to count, but we'll go ahead and call it a recession because it fits the definition, at least some people's definition, because I don't think we're really going to get over 6% unemployment or something like that. The unemployment rate won't go up enough, but we do need it to go up a little bit, and I'll explain why. And then I'll tell you where I believe I've been right and where I've been wrong with this whole market correction, and what I could do next time, and where I'm going to go from here. So let's go ahead and I'll tell you where it began for me. So for me, the market correction started in February 2021. And I was in a whole bunch of questionable stocks, and I knew it was gambling, but I was doing it anyway. And one of them I was in was CCIV. And on February 23rd of 2021, CCIV just plunged, and it's in the aftermarket, so I didn't even get a chance to get out. And even if you had to stop, you couldn't have gotten out because it was after hours. And so it plunged after hours. I was like, oh boy, the party's over. And so what happened? Well, on that day in February 2021, the market seized by the concept of rising interest rates and higher inflation fell steeply in early trading Tuesday. So as far back as February of 2021, we were already talking about rising interest rates and higher inflation. So there was one clue that this was happening. So what had happened was I started getting out of some of these more gambling type stocks and going back into what I knew were better stocks. However, I was doing it at a time when the market valuation was just large in general. So you can see here, this is 2021. February 21 would have put us right about here, and we would have had a market, price to earnings multiple of roughly 23. And we can see that's kind of a historic high because I was going into large cap stocks, and it was actually the highest since the dot-com bubble and the recession over here in 2001. And so, what would be a reasonable price to have gotten back in at? Well, we're sitting here at 23 times, and at the time I thought that was fine. And the reason why I thought that was fine is because I was caught up in there is no alternative, the TINA trade. You couldn't keep your money in the bank. You couldn't buy bonds because the interest rate was only like 0.72%. Really, it was the stock market, nothing else. So I did it, and I shouldn't have done it. But what I should have done was kind of like, I should have put my money into high inflation type of stocks like consumer staples, energy, utilities, things of that nature, but I didn't do it. But when this happens again, I will do it. And so what would be a nice place to like get into good growth stocks, and how far down will this go? Well, we can see that here 16 times the S&P looks like a pretty safe spot. So I would expect that the market could still go down some, down to like 16 times. And 16 times would put us about right here. So let's see, it's $408.32. So the SPY is at 40.83 today. And if we take the $408.32 and we divide it by the PE ratio of large cap S&P 500 stocks, which is 17.5, we can see we're at $23.33 a share right now. So this would be like a metaphorical type of share. Now, if we want to be at 16 times this, if we multiply this by 16, we could see that our price is 37.33. And so right now we're sitting at 4,083, and we want to be at 37.33. And so it still could have a ways to fall. It could fall, realistically another 250 points or so, and that would be all right with me. I mean, that's pretty much it. And of course, it could overcorrect to the downside. You never know how far these things are going to go down, but realistically, it shouldn't get too much below that. So 37.33 would be a reasonable floor for this. Now, I knew that way back when. Right? I knew that 37.33 or whatever, 16 times is, just looking at this chart is where you want to be. But here I was putting in money when it was at 23 times. So that was a clue to me that I was doing something wrong, but I did it anyway. So who was buying the bonds? And what was keeping the bond yields so low? So understand that when bond yields are low, bond prices are high. Because they'll sell it to you at whatever yield that you'll take. And so what was keeping the bond yield so low was the Fed. The Fed was artificially inflating fixed asset prices. And there was only two buyers of bonds in the world. It was basically the Fed and then these like bond buying ETFs right here. These are basically the only people that are buying bonds because no people were going to go out and buy a bond for 0.72%. And so like it would be like things like TLT, IEF, these were the things buying the bonds and the Fed. So if you did decide you wanted to get into bonds, when would be a good time to get into bonds? Well, they have to at least be good enough that they're better than the dividend returns on stocks. You have a great stock like this one, like Devon Energy, which actually, over the last year has appreciated 176%. And it's got a dividend of 7.16, which is way higher than the 3% bond yield that we have right now. So we got an appreciating asset with a 7% dividend, with a price to earnings ratio of 12 and a forward PE of 8.76. And this would be an energy company. And so what would possibly possess you to buy one of these ETFs when you could just go get um, Devon Energy? Or if you didn't trust that, you could get UPS. UPS right now, it's over the last year has been down 14%. Over the last 3 years, it's up 91%. It has a 3.5 or 3.38% annual dividend yield, which is still higher than the 3% bond, and you get an appreciating asset with a reasonable price to earnings ratio. So why would you buy a bond right now? And why might you consider something like a UPS over a Devon Energy at this time? Well, that's because Devon Energy is an energy company, and a lot of these commodities, I notice they tend to revert back to their mean. Like you can't politically allow, say, an energy company to just spiral out of control. It's just politically speaking, it's a bad thing to do. And so when you look at the max of, say, Exxon, it's at $92, and in 2014 it was $101, and in 2008 it was also about $92. So what happens is these things revert back to the mean. And so when you're talking about food stocks and energy stocks and things of that nature, they're always going to kind of come back to this acceptable like peak. And then I would say in the case of Exxon, we're looking at probably 77, maybe $80 is probably fine. It's not good, but it's fine. Any something less than 70 would be really good, because politically you can't allow energy stocks to spiral out of control the way you can, say, Microsoft or Amazon or Google. And so for that reason, I'm not a huge fan of buying these type of commodity stocks. And you'll see that it's right across the board, it's about the same here. So if we look, that was Exxon Mobil. If we look at, say, something like Arch Daniels Midland share, we'll see that this is a commonly known multinational food processing and commodity trading corporation. And if you look at it over 5 years, it's essentially going to revert back to the mean. It's going to start at like 50. Oh no, it needs to be down at 40, and then it goes down, and it comes back up to 50. And then right now it looks like the mean of this might be somewhere in this $60 range. So I wouldn't touch this with anybody's money right now. However, the price to earnings ratio is real low. Well, why is the price to earnings ratio real low for a company like this one that's a commodity asset right now? Well, it's really low because investors expect it to come back down here to like the $60 range. The same could be said for something like let's say Nucor, like a steel company. Now they recently just bought a garage door company recently that brought their price down, but right now Nucor is trading at a PE ratio of 4. So why would it be trading low? Well, people don't want the price of their steel to be high, and everybody knows that. The traders know that. So they expect that this company's probably going to come down, I mean, way down. Maybe not as low down as 60, but maybe $75 isn't unreasonable. So this is going to come back down here because we can't have our commodity prices spiral out of control. So you can't have your food prices. You can't have your how about something like Freeport McMoRan? Now it's going to be another cheap another metals and mining stock. And again, there's a lot of mean reversion here. It come all the way back down to 37. It got all the way up as high as 51, but we can't pay that much for our metals and mining. It's got a very low price to earnings ratio, but yet it keeps going up. Like it went up, but it's got to revert back to the mean. It's got to get back down here to 30. And now for years, this thing was like 12 and like 13 and $18. So is it going to go all the way back down there? It could. 17, $18 isn't out of the question. We've got to get this inflation under control. We can't do it if our commodities are going through the roof. And so for all these reasons, I probably myself am not going to get into these companies because Congress, The politicians have a reason to keep these prices down, and it's to lower inflation. So today, Powell said he was going to just keep raising rates until the inflation comes down. And the markets reacted pretty weird to this. Like yet they were still way up despite the fact he said he's just going to keep on hiking these rates. And he said that he's going to still have a strong labor market if unemployment were to move up a few ticks. I would say there are a number of plausible paths to have a soft, as I said, softish landing. Our job isn't to handicap the odds, it's to try to achieve that. So the Fed has the two mandates. It's the keep unemployment low, and they want to ensure full employment, and they want to keep inflation low. And what they think is that they can actually move unemployment up a few ticks and curb inflation at the same time, and it wouldn't hurt the economy at all. And I think that this is actually correct. I mean, we saw Walmart's earnings today. They got hammered because even though their revenues were up year over year, their earnings per share were way down because there's a lot of wage inflation and we got supply chain problems. And small business owners, I have like one friend, he works in the construction industry, and he can't keep people at his job site right now. They'll just up and leave at 10 o'clock in the morning on a Friday and just say, I'm done for today. And they can't be fired because there's nobody else to fill that spot. So how do you keep people at the job site? Well, they can't have as many options of places to go. And how do you increase your profit margins? Because Walmart's already has pretty thin profit margins to begin with. How do you increase those profit margins? Well, unfortunately, you can't pay people as much. You got to crank up the price a little bit, and because having really high wages eats into your profit margin. And so the market knows this. And so one thing they could do, as you can see right here, is that on May 3rd, 2022, you can see that the number of job openings was about 11.5 million jobs. And the number of unemployed is 5.9 million for an unemployment rate of 3.6%. And so the Fed is like, well, we can crank this up at least until there's 11.5 million unemployed because we have 11.5 million job openings. So they're looking at this like we can actually cause GDP deceleration and unemployment, and it still wouldn't hurt businesses. It's not going to hurt Walmart. It's not going to hurt my friend at the construction site. But the thing it is going to hurt, it's going to hurt our assets. It's going to hurt the stock market some. So I wouldn't be surprised to see the stock market fall a little bit further. And what am I going to do? Well, so last Friday we had that bear market rally where we had the short squeeze. And when I see these people having to cover their shorts, I'm just going to go ahead and just start selling covered calls into the teeth of that. And right now I've got a bunch of covered calls open. I'm going to just continue investing the way that I have been investing in the growth stocks because I'm not a big believer in these commodity stocks. These energy stocks are going to go up over time. You buy those, in my opinion, just for the dividend yield because they're just going to go up and down and revert back to the mean. And I'm also not a big fan of, say, consumer staples stocks because if I look at these stocks right now, and I know you're supposed to look at some, consumer staples in times of high inflation, but you look at these stocks right now, and they're trading at a price to earnings ratio of 27 and a forward PE of 26. Now, why would I buy Coca-Cola with no growth at all outside of the fact that they buy back their own shares? Why would I buy that when I could buy Google? And Google is sitting here trading at a price to earnings ratio of 20. So we have a stock with 30% margins that's growing at 20% a year and buys back an awful lot more stock than Coca-Cola does, trading at a price to earnings ratio much cheaper than Coca-Cola. Why would I buy Coca-Cola when I could buy Google? Another thing is, like, why would I buy, like, here's NVIDIA right here. Now, NVIDIA is one of my stocks that's given me a beating right now. But when I look at the price to earnings ratio of Nvidia, it's trading at 42. Its forward PE is 32. It's expected to grow about 30% a year through about 2026. What do these guys have? 30%. And so we've got a stock that's expected to grow at about 30% through 2026. And that means something. But when you look at something like, say, Clorox, which would be a big consumer staple, remember, NVIDIA's forward PE was 32. Clorox's forward PE is 37. Why would I be in Clorox? Yet this is where you're supposed to go, because you're supposed to go in the staples in times of high inflation. I just can't get my head around that. What about something like Costco? Here's a consumer staple that everybody seems to adore. Costco, that's where you should put all your money. Well, what is this one like? Well, it's got a price to earnings ratio of 39, forward PE of 37. Why would I be in Costco when I could be in, shoot, you pick it, Microsoft? Why would I do that? Microsoft is trading, if we're talking about valuation, we're talking about Microsoft is trading at a price to earnings ratio of 26 with a forward PE of 28. That's not true. It's actually growing, but that's not true. It's got a price to earnings ratio of 26 and a forward P of about 23. That would be based on a 16% growth rate. But why would I buy Costco when this one's cheaper and it's going to grow more? So for that reason, I don't see myself changing my strategy too much, even in periods of high inflation. And I say that now. I mean, if I ever see this coming again, I might actually change my mind and actually go into utilities and energy and commodity type of stocks, provided that they're at the bottom end of their range. I don't want to if because they're cyclical like that, because they are mean reverting assets. I wouldn't want to do it near the top of those cycles. All right, well, that's it for today. So a lot of this stuff, I should have seen coming, and I feel like I did see coming. And unfortunately, I didn't go into the stocks that my friend went into, which was the utilities, the oil, and the mining and stuff like that, and cash. And so I went into big tech and then had a rotating like cash position that I rotated with cash. So I'm gonna basically just continue holding on, and when we get these bear market rallies, like last Friday when we had that the people covering their shorts and their short positions, and then I just sold covered calls on top of that bear market rally. I'm just going to hang in there and just wait. My equities are good. And then I expect the market to go down a little bit more, but not a ton more. I think a lot of the selling is gone. I mean, even Warren Buffett is already buying. I think he bought he bought Citigroup, he bought Bank of America, Apple, Paramount. So he's dipping his toes in there. And if it's good enough for Warren, it's good enough for me. All right. So if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Bye.